If you've ever traded on margin before, you've probably experienced the rush that is associated with buying more stocks than what your own cash can afford and watching that number either move up or move down faster than it would if you had just used your own cash. And I hope this isn't you, but many people have also experienced a margin call where you buy something with borrowed money and then that stock starts to collapse. Your broker gives you a call and says, hey, you either need to sell, deposit more cash, or we're going to sell it for you. Not a fun place to be in. And the stock market has always moved up and down on these trends of margin because as the majority of the players in the stock market lever up, that's going to push prices up, but it'll get to a point where that movement up stops happening, selling starts, and then the price starts to drop, which forces liquidation across the board, driving down prices even more. So if you can watch this trend of the margin debt level building up and dropping, you can potentially front run this and be able to profit off of getting into a leverage position ahead of the curve and then getting out of it before the pop. And today we are going to look at the current state of margin debt across the stock market to provide you some insight on whether today is a good day to get into more leverage or to get out of leverage. Ready? Let's dive in. All right, this report is from Yardeni Research. They usually publish this on a regular basis. Stock market indicators, margin debt. This most recent one is from August 10th. So the first chart that we are going to look at from them is going to be the margin debt versus the Wilshire 5000 market cap. Now, if you're not familiar, Wilshire 5000, that's an index, 5,000 publicly traded stocks. So it basically makes up the entire stock market there. And we're not just looking at the price of the index, we're looking at the market cap. So in trillions of dollars, the total market cap, the total current value of all of the companies that make up all of the stocks in this index. And then the red line that we're going to be looking at is the margin debt in billions of dollars. And this chart goes back a long way. You can see here goes back all the way to the 70s. So this red line you can see periodically spikes. We had a big spike, obviously, at the dot-com bubble. We had a big spike in 2007. And then we had some smaller peaks and drops with margin throughout 2009 through 2017. And then we had another big run up starting in 2020. And then we've fallen since then. Now, what's important to recognize here is the correlation between the market cap size and the margin debt, because when margin debt increases, that simply means that there are more dollars that are being borrowed to purchase those stocks in excess of how much cash is actually available. So that will push up the market cap and subsequently the prices of these stocks. Taking a look at the chart again, we can see that this peak in 99 of margin debt preceded the big fall of the stock market when the dot-com bubble burst. And then margin debt bottomed along with the stock market, and we see a nice little trend here. Every peak in margin debt precedes a big drop in the stock market. And then every big drop in margin debt precedes a big run up in the stock market every single time. And what's important to note here is that at the beginning of 2022, when the stock market peaked, margin debt started to go down as well. So we've had a big collapse in the total number of dollars, billions of dollars, in how much margin debt is being used on stocks along with this crash in the market. That is a bullish indicator. That indicates that a lot of the selling that would be forced, a lot of the margin calls, a lot of the forced liquidations would have happened by now as the stock market has fallen and the margin debt has fallen as well. Moving on, let's look at this chart, which is the margin debt, but it's shown as a percent of the Wilshire 5000. And you can see that in 99, 2009, we had a big spike in margin debt as a percent. And then in 07 and 08, as a percent of the total stock market, it was also very high. And we've actually had a big decline in margin debt since then, which would indicate percentage-wise, we are at the point here where we are much less at risk of a large stock market drop due to an unwinding of margin positions. And then this next chart that we're going to look at is one of the most powerful charts here in terms of seeing how fast things have changed. This right here is margin debt, but it's the yearly change in billions of dollars. And so this shows what we were looking at in the first chart, which let's go back up. In this first chart here, we can see the red line drops along with the stock market, but it's really clear here, percentage-wise, how much we have dropped in margin debt. We have never seen a fall in margin debt in terms, this is billions of dollars, not percent, billions of dollars decline in the total amount of margin being used in such a short period of time. Massive, massive drop here. And here's that same figure, but it is in percentage change instead of billions of dollars. And so yes, we did see larger percentage drops back here in 99, and then we saw a significant drop in 08, but we are seeing pretty much the same sort of drop here. Now this would indicate that we have maybe a little bit more to go here if we're going to reach the bottoms of those percentage changes from 2000, 2001, and then 2008 to 2009. It would indicate we have a little bit further to go. Even though the dollar amount is so much larger right now, we can't just look at the dollar amount, because the dollar amount of margin, we have to look at that in light of how big the stock market is. And so the percentage change is going to more closely show how big that drop is in terms of the size of the market. And so this would indicate we might have a little bit further down to go in terms of how much margin is being used. This chart is the same as the first one, but instead of using the Wilshire 5000, it just looks at the S&P 500. And so we're going to see basically an identical chart here. And this one looks at the Russell 3000. So again, a very similar chart. And so you get the picture. When we're looking at the total amount of margin being used, that's the total amount of money that is being borrowed in order to buy more stocks. And so if you are going to look at this as an indicator, which it's a pretty good indicator here, you would want to be buying stocks and loading up, and if you're going to use leverage, you want to be using leverage and loading up on leverage at the time when everybody else has been liquidated, when everybody else has closed out their positions, has been margin called, has been forced out of their positions. Percentage-wise, we could have a little bit more to go to the downside here. However, you can never really time the market perfectly. You can never really peg tops or bottoms. What you really want to look at is getting close. So right now, it looks like we are pretty close to a bottom of amount of margin debt dropping, which means that if that starts to turn around, you start to have more buying and more levering up. If you get in front of that right now, you can ride that wave up. I'm not saying to be reckless. I'm not saying to do anything that you could experience large losses. Always hedge your positions. Make sure you're watching and not being emotional. Don't get tied to positions. And if they start to fall, just say, hey, I'll wait until it comes back. Never, ever, ever take large losses. Always take small losses, because if you always take small losses, you never have the possibility for a large loss, which means your gains will drive your performance. So make sure you are managing your risk effectively. But if you're going to use leverage and use margin, now might be a really, really close to the perfect time. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.